Since growth management involves comparing actual growth of the company to the sustainable growth rate or the optimum sales growth rate, we have to compute. Managing sales growth rate of the company involves comparing the actual sales growth with the sustainable sales growth rate. We can always calculate the actual sales growth rate by taking the percentage change in sales amount from a period to the following period. We have to develop the formula for calculating sustainable sales growth rate. Since the assumption of using sustainable sales growth rate is without external funding, the main source of internal funding is the retention of the company's profit. So we begin with SSGR by taking the change in equity, total equity for this period, minus the total equity last period. We divide by the total equity of times 0 or last period. That is nothing but percentage change in equity. Total equity of the company changed because of paid up capital or new shares issued, or because of an increase in retained earnings. As you can see from the derivation of the formula, SSGR depends on 4 variables. The retention ratio, RR, which is the proportion of the profit retained by the company or reinvested in the business. And the other 3 variables, net profit margin and TAT, represent the operational efficiency of the company. And equity multiplier is the leverage effect, the debt financing utilized by the company. So using this formula and these variables, we are going to compute the actual sales growth rate of the company PCP using the data from its financial statements for the year 2023. We have to have 4 ratios. The product of these 4 ratios will give us the SSGR, but to have the 4 ratios, we must compile the data from the financial statements. The first figure we need is the net profit, 11.9 billion. The net profit is taken from the income statement. Second is the sales and service revenue. Sales and services revenue is taken from the also income statement. It is the so-called top line, 374.5 billion Thai baht. We also take the total assets from the balance sheet of the company. Balance sheet has 3 sections: assets, liabilities, and equity. We take the total asset amount, that is 340 billion. We also take total equity amount from the previous year. The base year is 2022, 83.378 billion. The last number we need to compute is the dividend payout ratio, which comes from the statement of cash flow under the financing section. The dividend payout is shown on the statement of cash flow as a negative number. We have to ignore the negative sign. We only take the number. So using these 5 figures, we begin with the calculation of net profit margin, which is net profit amount divided by the sales amount. We get 3.18%. It's quite low. Net profit margin is low when it's less than 10%. And then we take the total asset turnover, computed as sales amount divided by total assets. That number shows net profit margin and turnover represent operational efficiency of the company. Margin indicates cost control, ability to control the expenses. Turnover shows management capacity to utilize the assets to generate sales revenue. We get 1.1, meaning from every $1 or 1 baht invested in Asadis in the year 2023, the company produced from that 1 baht or $1 investment $1.1. As long as the ratio is greater than 1, it is good, it's higher. Now we want to figure out the use of debt financing by the company. We have to calculate the EM, equity multiplier. We divide the total asset amount by the total equity amount, equity base. We get 4.08. It's not percentage, it's a pure number. It's a multiplier effect. Now we calculate the dividend payout ratio because we are interested in the proportion of the profit paid out to the shareholders and the proportion of profit reinvested in the business. Payout ratio is 27%. How do we get that number? Is the dividend amount divided by the net profit, 27%. 27% of the profit is given to the shareholders. Deducted from 100, we get 73%. Retention ratio, or the increase in retained earning, is 73% of the profit. We multiply these ratios using the formula SSGR equals to retention ratio multiplied by the net profit margin, 3.18%, multiplied by the turnover, 1.1, multiplied by the equity multiplier, 4.08, we get 10.43%. Meaning, depending on the product market condition, depending on the internally available financial resources of the company and its operational efficiency, the company can grow in the long term 10.43%. Now, is that high or low? We have to compute the actual sales growth rate and compare them.